All right, so this is part one of the video series on the income statement example that we would have done in class on Wednesday, September 11th, had class been held. So the file that I'm in that you see on the screen here is the income statement example file that is available on Compass in the class the class file for September 11th. And as you can see, we've got an income statement over here on the left, and then the area where I'm going to start for part one here is this income statement worksheet. And what we're going to do here in the first part is look at the accrual adjustments and fill those values in so we have those ready and we can quickly just reference those when we start entering them in on the balance sheet. And so I'm just going to start here at the top. We've got a partial list of business assets, a partial list of business liabilities, and then we have a number of items below here that we'll get to once we actually start transferring things over onto the income statement. So the first asset item that we're given is the business's cash balance. And what we're told is actually the values from both balance sheets for the 2008 year. So our beginning balance sheet is here as of the end of 2007 or beginning of 2008. And then we have the end of year balance sheet for 2008 as of 12/31/2008. Beginning of the year cash on hand for this business was $1,500. End of year was $3,500. So there was a change, but the cash account is not something that gets used as an accrual adjustment on the income statement. So changes in cash are actually reflected already in the cash values that we start with in each section. So cash revenues, cash operating expenses, cash interest expenses, those changes in cash that we see here across our balance sheets are already going to be captured in those cash numbers that show up on our income statement, as well as some of the items that are reflected on our cash flow statement. The next one is accounts receivable. So here we again see a change from beginning to end of year, and we saw an increase in the accounts receivables balance of $2,500. We know from the previous class where we started talking about accrual adjustments that this is a revenue adjustment. So this $2,500 is going to show up in our revenue section of our income statement. The next one is marketable securities. Again, this is one of those accounts that is not going to be used as an adjustment on the income statement. So marketable securities, again, are one of those asset types where we classify them as current, but we really oftentimes treat them as non-current for income and tax purposes. So even though the balance of these things changed, they may not have an income statement effect. So this could just reflect the value of marketable securities declining throughout the year. It might mean that the business sold some, in which case there might be something on the income statement, but we don't have enough information purely from the account values. We'd have to know the value of what was sold, how much it was sold for, and what its tax basis was, and then only the gain or loss would affect the income statement. Inventories, we saw a decline in inventories, so our adjustment will be negative. That is our other revenue adjustment. Moving on, we get into a couple of the asset accounts that are actually expense adjustments on the income statement. So they are asset accounts associated with expense items. These are our contra expenses. So prepaid expenses and supplies both fall in that contra expense category. The adjustment values here, prepaids declined from beginning to end of year, supplies balance increased. Those are both going to be contra expenses, and we'll do those adjustments. They actually are going to both show up in our operating section. Finally, we've got some longer-term asset values, similar to the marketable securities case. These are actually long-term assets, and the only time that these things are going to affect our income statement if there was a purchase or a sale, and then it would only be the income or the loss. So the change in the account values here, the change in the market values of these things, does not have a direct effect on the income statement. We would need more information to determine how this might or might not affect our income statement based on these changes that we see here. Okay, so again, marketable securities, machinery and equipment, real estate, there are no adjustments made based on those asset accounts. We've got the two revenue adjustments from accounts receivable and inventories, and we've got the two contra expense adjustments from the prepaid expenses and supplies. Moving down to the liability accounts now, these are all going to be, the ones that are accrual adjustments will be normal expense adjustments. The first one here is accounts payable. So we have an increase or a positive adjustment. That's going to be a normal expense adjustment, and that's going to show up in our operating expense section. The second one is notes payable within 12 months. Okay, and this is reflecting the value or the amount owed on short-term loans. Short-term loans, operating loans, short-term notes, all of these things are synonyms for the same term. Loans that need to be paid back within the next 12 months or within the next reporting period. Changes in loan balances, the principal amounts is what is reflected here, what was originally borrowed, do not affect income. Only interest associated with loans affects income. So principal balances on loans, whether it's short-term or long-term, does not matter. So that's not going to be an adjustment that shows up on our income statement. Going down to the next one, that segues right into our next liability account information for accrued interest. So we do have an adjustment here, specifically an increase from beginning to end of $1,500. So ending minus beginning is $1,500. That's another one of our normal expense accounts. That'll be an accrual adjustment that shows up in the interest expense section of our income statement. Next one is taxes, same idea. Here we've got the ending balance $8,000 lower than our beginning, so it's a negative $8,000 adjustment. It's a normal expense adjustment. It's going to show up in our tax expense section. Current portion of deferred taxes, another normal expense adjustment showing up in our tax section. Here, the current portion of deferred taxes, the adjustment reflects a $500 increase from beginning to end of year. Again, that's going to show up as a normal expense adjustment in our tax section. And then finally, other accrued expenses, or not finally, but this will actually end up being our last expense adjustment. $600 adjustment value, again, ending minus beginning is how you get the adjustment. This is another one of our normal expense accounts, accrued expenses. This will show up in our operating section along with accounts payable and the two contras, prepaids and supplies from up in the asset account information section. Finally, as I said, with the short-term loan, we've got a real estate mortgage here, which is almost definitely probably a long-term loan. And again, the principal amount, the loan amounts themselves are not income statement items. They do not affect the income statement. Only the interest associated with loans affects the income statement. So these things are not used as any sort of adjustment on the income statement itself. Okay, so we've completed kind of the upper portion of this income statement worksheet. Again, we've got the two revenue adjustments that will be transferred over to our income statement. We've got the two contra expense adjustments, which will be transferred over. And then we've got, looks like 5 normal expense adjustments that will be entered onto our income statement. Okay, in part 2 of the video, I will go over the bottom portion of this worksheet, and we'll take a look at some of the other pieces of information that will go onto our income statement, and we'll start entering those values on.